Hey guys, and welcome back to the Finance Now podcast. This podcast is purely for informational and educational purposes, and it's my way of sharing my knowledge, research, and opinions with you. I'm Anurag Birla, and a couple of topics this week that were of particular interest to me. I'm going to start with some India news. It's an economy that I love. I've mentioned it before. It's one of the fastest growing markets, and I wanted to take an active interest and effort in growing my knowledge about the industries and economies in the country. So to start off with, I wanted to first talk about the Foxconn and Vedanta joint venture deal that was happening. So Foxconn, the iPhone assembler, are dropping out of the $19.5 billion deal with Vedanta, the multinational mining company. Now, this is not the first time Foxconn have had a deal fall through, and while they gave a pretty vague explanation as to why, they did mention that the deal was ended mutually. Now, Vedanta is still looking for other partners to set up the foundry. Foxconn are still operating their other factories in the country. There's no effect on that. They have made it very clear that they have no intention of breaking away from the chip-making space in India entirely, just the investment for this particular plant in Gujarat, which they have dropped out from. Now, this is a definite setback in India's plans of becoming a manufacturing hub and a chip-making hub globally. Given the geopolitical tension that we see in China, it means companies are kind of looking for a way out, looking for different manufacturing facilities and looking for diversification on that front. And I would say manufacturing is also crucial to India's growth as an economy. And electronics manufacturing, chip-making manufacturing in particular, is a definite focus for India. Now, the Indian government have released a lot of government incentives to promote this, which is why I think Vedanta is still very much looking for other partners. And while I would say it is a blow to both, I would say it's more a blow to India's ambitions versus Foxconn's, it's not one that I think will really change the outlook of the entire industry or the overall course of action. If not Foxconn, there will be another that's willing to take up the investment, given the incentives. And, we see Micron, they've already committed to investing. So that's still a huge positive. Moving on to another story that was of interest to me within India is the sale of Adani Capital. Now, Adani Capital is the financial services arm of the conglomerate Adani Group, and it's up for sale. So, it's a big deal. I mean, Gautam Adani, the billionaire, is looking to exit his non-core businesses to conserve capital for core operations. Now, that makes a lot of sense. I mean, with this story, there are 3 private equity firms that are in a race to acquire 100% of the company. I'm not sure if that will end up being the case, depending on, whether the promoters of the company would like to retain some equity or not. But the 3 big private equity firms that are in the hunt right now are Bain Capital, Carlyle Group, and Cerberus Capital Management. Now, Adani Capital has 4,000 crores Indian rupees AUM, 800 crores in book value, and they are looking for about a multiple of 2 to 2.5 times book value. Now, that's around a 2,000 crore valuation, which is massive. I mean, the new investor will also infuse 1,000 to 1,500 crores into, the company as growth capital. And it does come as somewhat of a surprise, this sale, because last year we were talking about Adani Capital supposedly looking for an IPO in 2024, how they were looking to raise 1,500 crores, offering a 2% stake. But this was obviously before the short seller report from Hindenburg Research, which was deadly for Adani Group. I mean, there was a lot that went on around the entire operations of the business. And, now I think it makes sense when you see why he's trying to conserve some capital for the core operations. So Adani Capital provides retail and wholesale lending across 6 different categories, with agriculture being the largest of them all. It offers loans to small, medium-sized businesses, and the company has a presence in 9 of the prominent states in India, meaning there's some room to grow. While it's already got like good scale, there is some room to grow given the 28 states in total in the country. And yeah, as I said, it definitely makes sense that they want to focus their capital on some of the core operations. I mean, Adani Enterprises, we look at some of the other operations. Adani Enterprises was the highest revenue and profit growth out of all the arms, but they had low net margins. Adani Power had the highest absolute profit and a solid net margin. Adani Ports and Adani Green Energy did well too, amongst Adani Transmission and some of the other aspects of the conglomerates. So overall, I think it's a smart move. It's good for Adani. It's good for the shareholders. It's good for the company. And I'm pretty excited to see which private equity firm ends up winning this bid and how they go from there. Now I want to move on to talking about the US, and I'll start off talking macro. Inflation data this week, probably the biggest macro news we heard. CPI numbers were reported, and it looks good. I mean, good news for the 12th straight month. Inflation cooled, and that slowed to a 3%. That slowed to 3%, which is a sharp cool down from June last year. I think that was the peak. That was about 9%, and it's also a drop from last month, and it is at its lowest rate since March 2021, which is big news. The annual rate is down from 4% last month in May, and was slightly below expectations of what people thought would come in as 3.1%. It came in at 3%, so very slightly lower. But for 12 months ended in June, food prices were up 5.7%, grocery prices were up 4.7%, food away from home, which is essentially eating out, was up 7.7%. So that's a bit more expensive. But the caveat here is that core inflation is still 4.8% though, which is a reason, or which could be a reason, for the Fed to continue raising interest rates. I mean, I will say there is more good news on the job market front, with the lowest number of weekly initial jobless claims. So there is room for the Fed to beat down inflation aggressively, and I think the expectations already that, at the next meeting, the Fed are gonna unanimously kind of agree to raise the interest rate by 0.25%. We also saw some foreign markets do well on U.S. inflation data. Hong Kong stocks were up 2%. Other Asian markets also rose, the likes of Japan, Korea. So, I mean, obviously, it's the health of the economy is going in the right direction. We are poised for a good recovery, but I think complacency is a big worry, and I think the Fed want to avoid any sort of potential complacency that may arise. Now, the final story I wanted to talk about, and perhaps just dig into a little bit more, was Disney. I mean, it's a company, by virtue of just my age and my generation, it's a company I've grown up loving. But you look at the company now and you see that they're going through some serious trouble. I mean, the stock has barely moved year to date. I think it's up just about 1.5%, and it's actually down from 5 years ago. Bob Iger, the CEO of Disney, has extended his contract until 2026. Now, for context, why this is big news is that he stepped back in after the disaster of Bob Chapek. When he stepped back in, he said it would strictly be for 2 years. Now, he stepped back in 2022. The contract was expiring in 2024, and he has now extended it with unanimous vote from the board till 2026. In fact, the board actually asked him to extend his contract. Now, Iger has said that he has had to make difficult decisions to address some existing structural and efficiency issues, but he does believe that Disney's long-term future is very bright. Now, you look at Bob Iger, and he's one of the best CEOs I've ever seen, honestly, for a company. I mean, he's visionary. He's shown that he's been able to run the company through, ups and downs so effectively. And he also reinstated his intention to find a new replacement for him, as Disney's succession planning remains an elusive and unaddressed problem. It's not going to be easy to replace Bob Iger, but I'm pretty sure Disney can do better than Bob Chapek. I mean, the way he handled a lot of issues that Disney had during the COVID time was horrible. And I think after that disaster class, Disney have learned their lesson. But, I will say succession's not the only problem. It remains a big if. But, they have an ongoing battle with Ron DeSantis in Florida, governor of Florida. They have issues with their parks as well. So, I mean, what's going on with their parks? Why are their parks losing traction, per se? I mean, parks are dealing with a loss of foot traffic, which is unusual for peak summer months, as we're going through right now. Touring Plans, a company that tracks, wait times for rides at various theme parks, has reported shorter wait times in Orlando-based Disney World and Disneyland in California in recent weeks. The average wait time per ride was down to 27 minutes this year, during holidays from 31 minutes in 2022 and 47 minutes in 2019. So it's a huge drop from pre-COVID times. You see the discounts are being offered for Christmas, forecasts for earnings are lower. It's looking pretty messy, and you just wonder why it's almost halved the wait times. Has the crowd evaporated that much since pre-COVID? I will say this could be very inflation related or recession related, because we look at Universal Studios, SeaWorld, Six Flags, and they've all seen lower attendance too. So at least we can take some solace in the fact that it's not just a Disney thing. But it affects Disney greatly, also because the economics of their streaming business have just not been sorted out. I mean, it's messy. They are looking for a JV partner, a joint venture partner, or they're looking to sell their India digital and TV business. Now, in India, they face huge competition from Reliance, which is a massive conglomerate there. Reliance have incredibly deep pockets. They've been crushing it with their streaming platform, JioCinema. Disney lost their rights to the IPL, which is the Indian Premier League. It's the largest cricket league in the world, which was a huge loss for them because Reliance decided that they were going to stream it for free. Now, that's a big loss, and I think that was kind of the catalyst in them being like, hey, maybe this is not a market for us to compete in alone. We need to look for partners, or we just need to sell our business and focus on what matters. It could be part of their cost-cutting plans, and speaking of cost-cutting plans, they're also looking to cut back on the amount of Marvel and Star Wars content that they're going to be putting out. I cannot say how happy I am to hear this. It has been an actual abomination since that phase where they had Avengers, Infinity Wars, and Endgame. They have just overdone it. They have overdone it with the amount of content. I mean, on their streaming platform, they have all these shows that now, to understand the Marvel universe, you kind of have to be invested in everyone's storyline, and it was never the case before. Nobody wants to do that. So I think it's a very, very good and a very honest assessment of how Marvel and Star Wars as franchises are doing. And I think it can only be good for Disney for them to sort of bow out of this, of flooding consumers with so much content around these narratives. The diluted focus and attention are reasons. Bob Iger did mention there's too much content around these brands, and that cutting down would not only cut costs, but would also perhaps reignite some focus for the brands. I mean, they're just doing too much. They're just doing too much, and the impact they're having is just too little. So I think this makes a lot of sense. And as I mentioned, they need to sort out their streaming economics. They need to figure out their journey. The way Netflix have been crushing it is obviously putting pressure. Other competitors look to be progressing in the right direction. So Disney really need to figure this out, and maybe a turnaround story is on the cards. if you want to believe. I mean, I definitely think with Bob Iger at the helm, it very much could be. The price for the stock is very cheap right now. Maybe it's a good time to buy, and maybe I'm considering it, but I will take my time with this. I will see maybe how their earnings go this quarter and perhaps make a decision from there. But it could be a great turnaround story, and he's got 2 more years after his contract expires. So hopefully by 2026 we see a Disney back on the come up. Now I will say, take my advice with a pinch of salt. I'm not in any way indicating that you should buy it and the stock is a bargain right now. I'm just letting you know that it's something I'm considering doing. Please make decisions on your own, do your own research. And that wraps up this episode. So thank you all for listening. If you enjoyed this episode, I really appreciate it. Next week, we should have some earnings to talk about, as earnings season kicks off today. We have the banks releasing some of their earnings. So yeah, I will catch you next week. Hopefully it will be a nice earnings season that we're stepping into. I'm Anurag Birla, and this is Finance Now.